Hi and welcome to Swissquote's Daily Market Talk. It's Friday, September 26th. Yesterday's US GDP report came in just too strong for investors' comfort, with the fastest growth in almost 2 years, reigniting the debate over whether the Federal Reserve really needs to cut the interest rates and if 2 more rate cuts this year are still justified. The answer will obviously depend on how price pressures in the United States evolve from here. So we will dive into all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. Uh-oh was the first reaction of many investors out there. Because that US growth report yesterday was just a bit too strong for investors' liking. On the surface, strong GDP should be good news, obviously, but investors see it differently. As you know, the data showed yesterday that the US economy grew 3.8% in the second quarter of this year on an inflation-adjusted basis. Yes, 3.8% versus 3.3% penciled in by analysts and versus a 0.5% contraction printed in the first quarter of this year. So that's the strongest GDP read in nearly 2 years. It may be a surprise because the trade war was supposed to lead to the exact opposite result. Remember, slowing economic growth in the US and lost jobs. But for now, only jobs are being lost. Growth looks to be quite strong and even stronger than they expected and stronger than your wildest dreams. So the problem with that is such strong growth doesn't back further rate cuts from the Fed and accessorially boosts inflation expectations on top of potential tariff-led price pressures. Understandably so, the October rate cut expectations for the Fed took a hit yesterday after the strong US GDP read. The probability of an October rate cut from the FOMC fell from around 94% to below 88% yesterday after the data. The US 2-year yield that best captures the Federal Reserve rate cut expectations rebounded to 3.67%. That's the highest level since the beginning of September. And the US dollar index rallied past its 100-day moving average on readjustment in these dovish Fed expectations. And also the major US indices retreated yesterday after the strong US GDP data release from their all-time high levels, but managed to recover a part of the early losses. I actually believe that the buyers found in the inflation component a reason to buy a dip, if we can obviously talk about a dip in the actual market conditions, as inflation within the report yesterday was more contained than feared, just near 2% level. But sentiment in Asia, especially in the Asian technology-heavy indices, is rather weak this morning because the Korean Kospi index is down nearly 3% at the time I am talking here this morning, while the Hang Seng index trades 0.65% down right now. The Japanese Topix index is an exception to the bad mood in Asia because the index just hit a fresh all-time high level today, certainly boosted by quickly cheapening Japanese yen because the dollar yen is flirting with the 150 level this morning on the back of a broadly stronger US dollar, obviously, but also easing long maturity bond yields in Japan and a softer Japanese yen across the board due to a softer than expected CPI data out from Tokyo just recently. And just before we move on, the dollar yen is set to end this week, having confirmed a positive breakout above a key Fibonacci level and is now expected to trend higher in the medium run, with the next natural target for the bulls standing near the 151.65 level. Now coming back to the US affairs, the risk rally that we've been watching unfold isn't necessarily over, and the week could eventually end on a more positive note than the one that we experienced on Thursday's trading session, because today's US core PCE data, which is the Federal Reserve's favorite gauge of inflation, is actually expected to show easing in inflationary pressures on a monthly basis. On a yearly basis, it's another story because the core PCE is expected to remain sticky near the 3% level. So that is a level that's way above the Federal Reserve's 2% inflation target. Yes, Yes, but the Fed is now tolerating inflation higher than its 2% target, pointing at downside risk to the US jobs data. Hence, the PCE data in line with expectations today, or ideally softer than the market expectations, has all the power in the world to revive the risk rally in the US and across the global financial markets. If that data surprises on the upside, however, while the pose that we see to the risk rally could last a bit longer, with markets forced to reckon with the idea that the Federal Reserve may just stay patient well into next year before delivering more interest rate cuts into an economy where growth is strong and inflation is picking up. So fingers are crossed. The PCE data today will say the last word for this week. Now, looking closer to the FX markets, the euro dollar slipped below its 50-day moving average level yesterday in the continuation of the post-FOMC correction in the US dollar, reinforced by strong GDP data yesterday, and could easily print a deeper downside correction in the short run if today's PCE data doesn't convince the Federal Reserve those to stay in course. Cable, on the other hand, tanked to 133.23 level yesterday and will more likely than not continue its downside correction into the 131.30, 132 area, including the 200-day moving average and the major 38.2% Fibonacci retracement to the year-to-date rally in cable that distinguishes between the continuation of this year-to-date bullish trend and a medium-term bearish reversal. Now, note that political unease in the United Kingdom and upcoming autumn budget that's maybe going to bring some more tax rises on the table will make sterling look less appetizing in October. As such, the outlook for Euro-Pound remains comfortably positive for the next 4 to 6 weeks of trading. In precious metals, when yields move higher and the dollar strengthens, gold usually feels the pressure, and that is exactly what we saw this week. The yellow metal lost some shine into the $3,800 per ounce mark this week as the US data actually tempered the dovish Fed expectations. Still, note that gold has not broken down in any meaningful way, and that is basically because the other side of the story is still very much in favor of the precious metal. 1. Inflation expectations remain quite anchored. 2. Geopolitical risks are simmering. And 3, the central bank demand $4 billion continues to provide a strong backstop. What is also very much interesting here is that gold has actually been holding near elevated levels, and that despite rising yields in developed markets. So that's a relationship that historically would have pulled gold prices lower, but no, and that actually suggests that investors aren't holding gold just as a race hedge anymore, but they're also holding gold as a strategic allocation in their portfolios, a kind of insurance policy against policy mistakes, market volatility, and or unexpected geopolitical flare-ups. So the outlook remains comfortably positive for gold. Now, the near-term price action may actually look choppy with further recovery in the US dollar, but the broader bullish trend remains intact. So if today's PCE number shows inflation easing further, gold could eventually get some breathing space as yields and the US dollar would retreat. But even if it's not the case, price dips are still interesting buying opportunities for investors who want to have gold in their portfolios in the longer run. And the rally has, according to many investors, way more room to run. And we actually had a very interesting discussion with NFT partners Glenn Coxon on the matter this week. So that discussion will soon come out. So I really recommend you to catch up when that fourth quarter outlook is out in the coming weeks. But this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.